Do you know what a credit score is and why it's important? Picture this. A credit score is like a financial report card, a summation of your money habits. It tells the story of how you handle your finances, reflecting your punctuality in paying bills, your debt levels, and your credit history. Just like school grades, high scores are applauded, while low scores can be a cause for concern. So, a credit score is not just a number, it's a reflection of your financial health. Meet Jane, a young woman living in London. Jane didn't know much about credit scores until she was denied a loan. Just like most of us, Jane was living a life of blissful ignorance. She paid her bills, mostly on time, and thought that was enough. That is until she applied for a loan and was denied due to a low credit score. Baffled and a bit embarrassed, Jane decided to educate herself. She discovered that her credit score was more than just a number. It was a reflection of her financial behavior and the key to securing her financial future. She learned that late payments, high credit card balances, and frequent loan applications negatively affected her score. Determined to turn the tide, Jane started paying her bills before their due date, reducing her credit card balances, and being more judicious about applying for new credit. Slowly but surely, her credit score improved. Jane's story is a testament to the fact that understanding and improving your credit score is possible and crucial. You might be wondering, how are these credit scores calculated? Well, it's not magic, it's math. Let's break it down. There are 5 components that make up a credit score: payment history, credit utilization, credit history length, credit mix, and new credit inquiries. Payment history is the most significant part, making up 35% of your score. It's simple. Pay your bills on time, your score goes up. Miss payments, and it goes down. Next is credit utilization, which is how much of your available credit you're using. This makes up 30% of your score. The lower your credit utilization, the better. Credit history length, or how long you've had credit, makes up 15%. The longer, the better. Your credit mix, the types of credit you have, and new credit inquiries, or how often you apply for new credit, each make up 10% of your score. As you can see, a variety of factors contribute to your credit score. It's not just about how much money you have. In the UK, a credit score from 881 to 960 is generally considered to be excellent, while in the US, a good credit score is typically between 670 to 739. So, why should you care about your credit score? Well, let's dive in. Firstly, a good credit score can be your golden ticket to better interest rates. That means you could pay less over time for that dream car or home. It's like a sale that never ends. Plus, it can make the process of getting approved for loans and credit cards a breeze. But what happens if your credit score isn't so rosy? A poor credit score can make things a bit tricky. It can be like trying to run a marathon with a heavy backpack. You might face difficulty getting approved for housing, or even if you do, you could be hit with sky-high interest rates. Imagine paying more for the same thing just because of a few numbers. So, whether you're looking to buy a new home, start a business, or just want to keep your options open, nurturing a good credit score is essential. As you can see, your credit score can open doors for you, or it can make life more challenging. Now that you understand the importance of a credit score, how can you improve yours? Well, let's dive right in with some practical tips and tricks to nourish that credit score of yours. First and foremost, a golden rule to follow is paying your bills on time. Late payments can significantly ding your credit score, so set reminders or automate your payments to avoid forgetfulness. The second tip is to keep your credit card balances low. It's not just about paying off your debts on time, it's also about how much of your available credit you're using. This is known as your credit utilization ratio. A lower ratio is better for your credit score, so try to keep this number under 30%. Now, you might be tempted to close old credit cards, especially those you're not using anymore. However, keeping them open can actually benefit your credit score, as long as you're not racking up unnecessary charges or annual fees. This can increase the overall credit available to you, lowering your credit utilization ratio. And let's dispel a common myth while we're at it. Contrary to popular belief, checking your credit score does not lower it. So, feel free to regularly monitor your credit score and report. It's a good habit that helps you catch any errors that might harm your score. Improving your credit score isn't a quick process, but with patience and discipline, it's entirely possible. Remember, it's never too late to start.
If you enjoy this type of content, do acknowledge it with a thumbs up. Subscribe and stay connected with our community for more content. Until next time, take care.